You've been learning about value investing, finance, just regular investment for a while now, but you don't know where to go next. You're getting confused about the vast amount of information on the internet. You don't want to waste your time on crap information. You want good information and reliable information. In this series of videos on value investing and finance education, you will find those answers to those questions and much more. My name is Jason Rivera. Welcome to Value Investing and Finance Education.
Hey, Jason here on a rainy and crappy day here in the Tampa area. Today I want to talk about my thoughts on diversification. If you followed me for too long, you probably know my thoughts on it, but for those who are new or those who are probably maybe forming their opinions on this a little bit, this is kind of geared more towards you guys, the newer people, and also kind of reinforcing my followers of my blog and my YouTube videos and stuff like that, my thoughts on diversification, because it's frankly a topic that doesn't come up very much unless you read a book or you see a company get hammered because of their lack of diversification or whatever it is. So I want to give my thoughts today on diversification, and in the normal sense, I don't agree with the normal kind of investment finance definition of diversification, where you own 10 to 30 stocks or whatever it is. You own assets in all different classes, all those kind of things. Like a lot of stuff I talk about, I know I'm different here, and my opinions on this are different than most others that I know, even in this realm. I'm not a big believer in diversification, especially in its normal sense. At my kind of least diversified point, after stocks I'd owned for years had either gotten bought or merged with other companies, I was down, this was 3-4 years ago now, the portfolios I managed were down to 2 investments, and we're in 80% cash. Everybody else, pretty much everybody else that I know, would say that's insane. At my kind of normalized, I guess, best way to put it, diversification range is I would own 5 to 10 stocks in the portfolios I manage, and owned several apartment buildings and private businesses. At least in terms of how my personal business is growing, that's what I will own when we get to that point where we can own several private businesses and several apartment complexes. So what about normal diversification? I think that's frankly for suckers. If you diversify too much, you are just going to track the market. You're going to do about on average with what everybody else does, which is pretty much tracking the market. If the market goes up, your portfolios are going to go up. If the market goes down, your portfolios are going to get hammered, just like the stock market. That's why I have a problem with a lot of mutual funds, in particular index funds to a lesser extent, but particularly 401k plans, retirement savings plans in quotes. They just track the market. They're not going to ever really beat the market by more than 2 percentage points or lose to the market by more than 2 percentage points. But if you're just trying to track the market and do what the market does, which is fine over the long term, frankly, if you don't know how to pick individual stocks and businesses, that's fine. I completely 100% think you should do that. You should either, if you don't know how to pick individual businesses, you should either find somebody like me who loves doing it and is pretty good at doing it, or you should invest in low cost index funds and forget about the money for 20 years. But if you're looking to outperform the market, diversification is likely going to cripple your returns, not only due to the fees, but due to the spread out of ideas. My kind of favorite thought on this is Warren Buffett's punch card analogy. He said, imagine buying a stock or a business, and you only have 20 punches on a punch card. You can only buy 20 investments for the rest of your life. I want to know my investments intimately. That's why I would ideally be in 5 to 10 stocks, maybe a handful of handful of private businesses, handful of apartment building complexes, at least until I can bring on another team member who can help me with these kind of acquisitions or analysis. Then we can kind of scale. Once we get to that point, it doesn't really matter, because they would be trained on what I'm looking for and that kind of things, and we can spread out our ideas and our thought processes. But as an individual, diversification doesn't make any sense to me whatsoever, because if you're diversified in the normal finance sense, you can't intimately know 20 to 30 different stocks in your portfolio. It's impossible. Again, unless you own them for a long time. I'm talking about individual picking stocks. You're going through hundreds or thousands of companies at a time to find an investment to buy. I do literally hundreds of hours of research just to have the potential to buy a stock investment business, public company business. So I know my companies inside and out, and that's why I don't diversify in the normal sense. I would rather personally know my investments inside and out, know their economics inside and out, know their profitability metrics and their management inside and out, than be at another way to put it is, would you rather put most of your money in your top 5 ideas or your top 20 ideas? Because your 20th best idea can't be nearly as good as your 5th or even your 1st best idea. That's another reason I don't agree with normal kind of finance and investment diversification. I'm more of the Warren Buffett, where I know something intimately, I know whether I want to buy it or not, and I spend a ton of time researching it and its industry, or I have spent a ton of time researching it and its industry, depending on the situation, and then I make a move, and either we do the deal or we don't do the deal. But knowing investments on a kind of ancillary, just kind of surface basis, to me doesn't make any sense. To me, just because you own something, your 30th stock in your 30th different industry, doesn't mean you're going to be safe when the market crashes. Just means you're going to crash along with the market. I will crash along with the market too. My portfolio will crash along with the market too, but because I know my businesses, and they're typically good to great businesses where I can trust managers, they produce a ton of cash flow, they produce a ton of profits, their balance sheets are very healthy, and I know all this inside and out, and again, I trust management, which is rule number 1 for me, then I typically don't sell. I just kind of hold on and wait for the stock to go up, for something either negatively to change, or for the stock price to go back up, and I might even buy more just if nothing has changed in a negative sense. So those are kind of my thoughts on diversification. Again, I know I'm far different here than most people, but again, I'm coming at this from a business owner perspective. I don't own stock pieces of paper. I own fractions of a business, and eventually entire businesses. Once my businesses get to the point where I can use some of that cash flow to buy other businesses or assets like real estate investments. So yeah, I'm not a big believer in the normal sense of diversification. Anytime anybody comes up to me asking about stock advice, or will you manage my money, or anything like that, I kind of go over this whole thing. It usually scares a lot of people away, because frankly they are used to the normal diversification, 10 to 30 stocks or whatever it is, bunch of different asset classes, bunch of different industries, stuff like that. I go where I can find undervalued assets. If I can find 20 massively undervalued assets in a certain industry, where I can trust management. Actually, let's back up, because that won't happen. So let's say I can find 3 great businesses in a single industry. I trust all their managements. They produce a ton of cash flow. They have strong balance sheets, a lot of cash compared to little or no debt. Those kind of things, I will buy all 3 companies if they are undervalued enough to fit my criteria. I don't care about actually 2 companies I own right now are in the same exact industry that is very cyclical industry. So that doesn't bother me at all, but I trust their managements and they fit those criteria just outlined. So, but I'd love to hear your thoughts on diversification, because again, like some of the other stuff I've talked about, I know this is far different. My thoughts on this are far different than almost everybody else out there, except for Warren Buffett and a handful of other value investors and business owners. But I'd love to hear your thoughts on this in the comments below. If you have any questions, make sure to let me know in the comments below, because I get a lot of questions about diversification all the time again. And specifically when it comes to, never mind, I'll talk about that in another video, what I think about retirement plans and stuff like that. So, but if you have any questions, comments below, let me know in the comments. Make sure to like the video if you like the content and like my thoughts on it. Make sure to share it and hit the subscribe button and hit the bell, so you're notified anytime we release a new video. And I will talk to you soon. Oh, before I go, we have playlists to the right, left, bottom, depending on where you're watching, on other value investing and finance education. We have talk on mental models. We have book reviews. We have case studies, value investing case studies. We have all sorts of talk on, I talk about crypto and speculative investments. We have all sorts of talk about different topics, value investing, finance, learning, book reviews. Make sure to check out our playlist to the right, left, bottom, depending on where you're watching. And I hope you like our videos, and make sure again to subscribe if you do, and hit the bell. I'll talk to you again soon. Thanks. Bye.